On June 17th, Chinese leader Xi Jinping attended and addressed the St. Petersburg Economic Forum via video, which Vladimir Putin attended as well. On that day, Russia's St. Petersburg Stock Exchange announced that effective June 20th, it would allow the trading of 12 Hong Kong stocks, including Alibaba, Tencent, and Xiaomi, among others. The Russian state-owned Sputnik News said that the number of Hong Kong-listed stocks to be traded on the Russian exchange would increase to 50 in 2 months, 200 by the end of the year, and more than 1,000 next year. Are the Chinese and the Russians getting closer than ever to counter Western sanctions? Hello, welcome to my show. I'm Lei. The announcement came 2 days after Xi Jinping and Putin held their first conference since the two signed a pact at the Beijing Winter Olympics. Interestingly, it was reported by Russian media, but not the Chinese press. I think Xi Jinping wants to stay low-key to avoid U.S. attention. Shortly after the West booted major Russian banks from SWIFT to sanction Russia, Fortune magazine published an article titled, "China has the financial infrastructure to provide Russia with a SWIFT alternative, but it may not have the political will." The report stated that the U.S. feared banning Russian institutions from SWIFT might result in Russia's inching deeper into China's financial world. After 3 months, this fear became a reality after China got the political will. The St. Petersburg Stock Exchange, or SPB, is Russia's second largest stock exchange, with an average daily trading volume of $1.3 billion. Compared with Nasdaq's daily trading volume of $244 billion and the Hong Kong Stock Exchange's $15 billion. The SPB is very small in scale, but it specializes in foreign shares, mainly U.S. stocks. As of mid-June this year, before the addition of the new Hong Kong stocks, there were roughly 2,000 stocks traded on the exchange, of which 1,800 were U.S. stocks. That's 90% of the Russian exchange's tradable stocks. Due to the sanctions, Russia's central bank announced at the end of May that it would restrict trading in foreign shares blocked by international clearinghouses. It would transfer up to 14% of U.S.-listed shares that its clients possess to a non-trading account. Wealthy Russians have withdrawn their money from European and American markets, and their money is looking for new investment channels. From a political point of view, it is not safe for Russians to invest in U.S. stocks. Since Russia and China are allies, investing in Chinese stocks is a safer option at this point. The Hong Kong Stock Exchange thus became an ideal alternative. It's reported that the trading of Hong Kong stocks will be conducted in Hong Kong dollars. Trading in Hong Kong dollar avoids the risk of sanctions against the ruble by the Western nations. Currently, the Hong Kong dollar is pegged to the US dollar, so using Russian capital to buy Hong Kong stocks denominated in Hong Kong dollars is the same as holding foreign assets pegged to the US dollar. This move is undoubtedly risky for Hong Kong. Will the Hong Kong Stock Exchange and its stocks be implicated, including with Russia, and forced to face sanctions? After the Russian exchange announced it would trade Chinese stocks, the Hong Kong exchange denied any partnership with the SPB. It said that it believed the scheme was part of the Russian exchange's global issuer promotion program. So why does the Chinese Communist Party risk being sanctioned by the West to bundle up with Russia? The first reason is that the Chinese regime desperately needs an infusion of cash. The abysmal performance of Hong Kong's IPO market has long reflected the city's precarious position as a world financial center. From Beijing's perspective, why not take advantage of idle Russian capital to help boost the Hong Kong stock market? Secondly, the regime has been preparing for U.S. sanctions. The Hong Kong Monetary Authority stated in early May that it had prepared emergency plans in case Hong Kong or mainland China is eventually sanctioned by the U.S. Around 200 Chinese companies face the risks of being delisted from U.S. stock markets for non-compliance to financial disclosure policies. The CCP is determined to find a more suitable place to recoup money and raise capital, while being independent of the United States. Singapore is an option, but Beijing is unwilling to put all its eggs in one basket. Plus, Singapore is very pro-West. Russia has thus become a good option. But a more critical factor that propelled China and Russia to join hands at this time is the U.S. economy under Joe Biden. The U.S. is suffering the worst inflation in 40 years, and the fear of a recession is mounting in America. As gasoline price soared over $5 per gallon, President Biden's approval rating tanked, and his Democratic Party faces great pressure in the upcoming midterm election. American political media outlet The Hill said, "Virtually no one in either party expects the president's party to hold on to its thin House majority, though the prognosis in the Senate is not quite so bleak." Banking on the idea that Biden won't have the bandwidth to deal with them for the time being, China and Russia took the opportunity to join forces in economic collaboration. Some analysts believe that Hong Kong is safe, at least for 2022, but it's hard to say what will happen after that, particularly after the U.S. midterm election and the CCP's 20th National Congress, both in the fall. To diversify risks and mitigate the risks of escalating U.S. sanctions, the Hong Kong Stock Exchange is planning to allow cash market traders to use multiple clearing banks to settle transactions, as reported by Bloomberg on June 21st. Due to high capital requirements, there are only 8 authorized clearing banks for the Hong Kong Stock Exchange, of which 5 are European banks and 3 American. The Hong Kong Exchange's plan will, on the one hand, be able to protect transactions if a clearinghouse has problems. On the other hand, it can help investors respond to U.S. sanctions imposed on Chinese companies. Beyond collaboration in the financial sector, at the same economic forum attended by Xi and Putin, Chinese ambassador to Russia said that Beijing was ready to supply aircraft parts to Russia, according to Russian news agency TASS on June 17th. After Russia invaded Ukraine, Boeing and Airbus stopped supplying the Russian aviation industry with aircraft parts. Fearing secondary sanctions, Chinese companies also turned down Russian requests for aircraft parts in March. But the Chinese ambassador didn't say whether China would provide aircraft parts for Russian military use. Ultimately, what brought Xi Jinping and Vladimir Putin together is the similar predicament they're both in: a hostile global environment, a struggling domestic economy, internal political threats, and growing public discontent. They might have found a short-term solution by staying close, but it's hard to say what will happen in the long run. After 3 months and having assessed the current geopolitical situation, China and Russia decided to make their alliance more tangible and visible. Xi Jinping is taking a big gamble based on the assumption that Joe Biden is embroiled with domestic issues and won't push forward with more sanctions. Is his assumption correct? Only time will tell. Since I mentioned Singapore, here's the video about wealthy Chinese moving to the Southeast Asian country, and the other video is about Vietnam, which many say is becoming the next China. That's all for today. Thank you. See you next time.